What's going on, guys? Crypto Renegade here. In today's video, I'm going to talk about the top 3 reasons most people lose money trading crypto. We're about to see the most crucial mistakes that people make while trading crypto and how you can possibly avoid them. Let's get right into it. But before I jump into the content, I just want to promote again my free ebook on the 7 best ways to secure your crypto updated for 2021. It's 100% free. So check it out in the description. It'll also be pinned in the comments, and let's get started. Okay, now we're about to enter a realm that we've never mentioned before on this channel. So I'm gonna try to explain everything very simply here. And to be fair, I personally have fallen prey to some of these we're about to talk about in my earlier days. My hope is that you can learn from this and avoid losing any of your valuable coins, basically. So let's start with the number 3 reason why people lose money trading crypto. Number 3 is leverage trading. Okay, now what is leverage trading exactly? Leveraging is one of the most powerful tools traders and investors have in their toolbox to increase returns if, and a big if, you have sufficient experience.
I do have a very particular set of skills. Skills I've acquired over a very long career. Skills that make me a nightmare for people like you.
Leverage trading can dramatically increase your returns, but in the wrong hands, it can have a very devastating effect, not only on your cash flow, but for your psychology as well. Leverage trading, which is also known as margin trading, margin finance, or trading on margin, allows you to open a trading position with a broker using a small amount of capital in order to take a much larger position in the overall market. For example, in some countries, if you have $1,000, you can leverage your trading position up to 100 times or more. So if you leveraged at 100 to 1, you would be exposing yourself to managing a position of $100,000 in the market. So why do people lose on crypto leverage trading? Not spot trading, specifically leverage. Well, when trading on margin, the margin itself is typically expressed as a percentage of the total position size. For example, Forex brokers will say that they require 1% or 0.5% or 0.25%, which allows you to calculate the maximum leverage you will be exposing yourself to when opening a trade. So if you put up $1,000 and decide to open a leverage position on a 0.5%, your exposure to the market would be $200,000. Fortunately, if those individuals with very little capital and knowledge regarding the crypto markets who are attracted to this highly leveraged markets because they believe they'll become much wealthier in a shorter period of time than from any other method of trading, get rich quick. In reality, however, this is very far from the truth. You need discipline.
It's a matter of focus, commitment, sheer will.
Let me say, if you are serious about wanting to succeed in the crypto markets over a very long term, you must follow the number 1 trading rule that applies to any market. The higher the risk, the greater level of knowledge and experience is required to manage that risk, which becomes even more important when trading leverage products in a very volatile market. The second reason why people lose money on cryptocurrency trading. Number 2 is FOMO and following the wrong people. So we all have heard of it. FOMO, or fear of missing out, is a real phenomenon that's becoming increasingly more common and can cause significant financial stress in your life. It can affect just about anyone, but some people are also at a greater risk. So what is FOMO on a deeper level? The fear of missing out refers to the feelings or perception that others are making more money on the crypto market than you are right now, thus living better lives or having more fun than you. It involves a deep sense of envy and affects your overall self-esteem and psychology. It's often exacerbated by social media sites like Instagram and Facebook. You see, all these platforms do is that they hype up a crypto, usually some new coin, with influencers sporting their filled bank accounts, making you feel like you're missing out on a huge opportunity. Also keep in mind that these people get paid to shill you something that they don't have any idea about. For example, Kim Kardashian shilling Ethereum Max. Since the advent of social media, FOMO has become more and more obvious and has been studied more and more often. Social media has accelerated the FOMO phenomenon in a lot of ways, pretty obvious. It provides a situation in which you are comparing your regular life to the highlight reels of other people's lives. FOMO when it comes to crypto trading. Social media creates a platform for bragging rights. It is where things, events, and even happiness itself is seen to be in competition with others at times. Huge fallacy. People are comparing their best picture-perfect experiences, which may lead you to wonder what you're lacking or to doubt yourself. That's when people with little to no knowledge of the crypto markets fall prey to so-called experts on TikTok or on other social medias only to scam you. I mean, haven't we all seen those ads? You know, the ones where there's a guy riding in a brand new Lambo saying he was able to buy that by investing only a couple thousand on a specific crypto. You know exactly what kind of cringy ads I'm talking about. And the catch is that they make you feel as if you don't have to do anything else but invest your hard-earned money, and there's no risk, into some unknown crypto asset, and boom, your life is gonna change overnight if you just listen to them.
Here in my garage, just bought this new Lamborghini here. It's fun to drive up here in the Hollywood Hills.
Unfortunately, the truth is very far from this. Instead of being gobbled up by FOMO and listening to some scammer who's only preying on your insecurities, you should actually take time to study and do your own research when you enter the market, and most importantly, when to get out of it. Which brings us to the last and most important reason why people lose money on crypto trading. Numero uno, not having a plan or a strategy, or maybe you should just HODL. You can sell, bid, or buy, or just HODL any crypto just like a stock. However, another thing the stock and crypto markets have in common is that each of it has its own basically unique jargon. So what does HODL mean? Hold on for dear life. It also was a typo in a Bitcoin talk forum back in the day where it was suggested that the person who wrote this was intoxicated when he meant to type or say hold. Only that person can really know for sure.
You know where you hope this train will take you, but you can't know for sure.
Any investor who buys and holds crypto may be called a hodler. There are some people who truly believe that cryptocurrencies will eventually replace fiat currencies and form the global economic foundation of the future. These hodlers are loyal to the very end. They're unswayed by sudden price changes, fake news, sarcastic memes, or any other viral content spread throughout social media or other influencers. Hodlers hold their coins while they ignore the naysayers and overhyped price predictions. So how are hodlers supposed to know when to actually sell? Well, to date, traders could not use traditional financial concepts to predict accurate crypto price movements. All we have is history, which is very short. Many have tried, but every attempt has been stymied by the unprecedented volatility of this market. Even the most accurate price predictions based on fundamental or technical analysis have been shown that no methods are sufficiently consistent to qualify as a technical strategy. Truth be told, you never know what the market will do. You also can't predict the future. That's why it's so hard to predict when to buy, sell, or hodl your crypto at any point. Always keep a watchful eye and your mind open rather than adjust your mind to hodl until a specific time or price is reached. If you ever do decide to hodl any crypto, which I hope you do, keep an eye out for any news or events that impact the price of that invested crypto and choose a time frame. With this still being fresh in a loosely regulated market, there are still so many potential risks that it could affect the price enough to influence your decision whether to hodl or sell your coins. Just don't panic. If you really don't know how to trade cryptocurrencies, you're not alone. But what exactly should you know about crypto trading? Again, I'm no financial expert, but crypto trading is still very new to most people, really everyone. Until recently, there was no reliable data on which new traders could rely on to measure past performance other than a short chart. Many traders had to learn or sink or swim thinking they're diving into uncertain depths of crypto trading. Then there are those who are preferred to wing it as they carefully navigated the uncharted waters. Part of investing in crypto is learning what works for you as an individual, knowing your own strengths and weaknesses. Be the one to mitigate the risks, and that means you will have to determine when it's right time for you to sell. No one can tell you with certainty when to hodl or when to sell. If they do, they're lying. However, it's a good idea to listen carefully to any advice or tips given by a professional with years of experience in watching and learning what influences the overall crypto markets to rise and fall. Again, I don't give personal financial advice. I'm just a guy on YouTube who loves crypto. Steer clear of any channel that says they will make you a millionaire on their secret coin picks. Many cryptos have come and gone just because they've lost traction with no rhyme or reason. If you don't believe me, feel free to take a look at a snapshot of what the top 10 cryptos were in market cap in 2015 by using the snapshot tool on coinmarketcap.com. It's very interesting. Others fell down only to jump back twice as high. For example, Bitcoin rose by 52,000% from 2011 to 2013 and then fell by 80% the next year. Since then, it has shot up over 17 times its previous all-time high, only to fall by half again. A common mistake among hodlers is missing the chance to cash out profits at the height of a rally. But the most serious mistake that you can make is to buy high when everyone is euphoric and then panic sell when the price suddenly drops or crashes. Part of learning when to hodl or sell is realizing that it's not always wise to hold all of your coins. Volatility makes the market likely to have some extreme spikes and crashes. But if you've entered the market of a coin that you have very well studied and you are very well convicted, then you know when to sell. Follow your own logic, your own intuition, and don't just blindly stay in the market without a strategy or simply because you feel loyal to a coin that you've bought.
You got no mercy. You got no fucking loyalty. And you got no code.
With all that being said, that was it for today's video, guys. I do hope it was helpful. Let me know your opinions about this in the comments or if you disagree. And also don't forget to like, share, and subscribe. And I will see you guys in the next video in the top right corner here about not being able to buy any more Bitcoin by 2024. See you guys in that video now for the explanation. Crypto Renegade out.